This is Money Talk on News Talk 580 CFRA. Here is John Budden.
Good afternoon, folks, and welcome to Money Talk. Give you a rundown of today's show. We start with Tom Peckloff of the Ottawa Business Journal, and then we go to a fun interview with Kevin O'Leary and our affiliate BNN on the value of the Blue Jays Baseball Club. And on to my talk with Matt Hendricks, Senior Vice President, National Sales at Sprott Asset Management, and then my interview with Eric Nuttall, who is the Portfolio Manager of the Sprott Energy Fund. After the news, we go to Trevor Parry, who is an expert in taxation matters, which is a subject on all our minds. And we conclude the show with my interview with Steve Higgins, who is Director, Storage and Refining Solutions at the Royal Canadian Mint. But first, let's go to Tom Peckloff of the Ottawa Business Journal. My thanks to Tom Peckloff, who has joined us from the Ottawa Business Journal this afternoon. Tom, how are you?
I'm doing well, John. How are you?
I talked about no more skiing last week, and here we have lots of snow. So,
I know.
Tom, lots of tech news this week with a major acquisition, a new funding initiative, and a lecture on how to create a cyberspace hub.
Yeah, that's right, John. Let's start with Solus Systems, a router provider here in town, hardware and software versions of their product. Now, Bridge Growth Partners, which is a New York-based private equity firm, acquired a majority interest in Solus this week. Solus CEO Craig Betts says the deal is 9 digits U.S., and as far as he knows, the largest private capital transaction that has ever happened in Ottawa. Now, Bridge Growth may be from New York, but very strong Ottawa ties. Chief Administrative Officer Tom Manley was a Nortel VP for 16 years and CFO of Cognos for 7 years after that. Former Cognos CEO Rob Ashe and Senior Vice President Peter Griffiths are on Bridge Growth's Tech Advisory Board, and former Deputy Prime Minister John Manley is on a Strategic Advisory Board. Now, as for Tom Manley, he and Mr. Betts knew each other socially. They started talking about the possibility of a deal about 6 months ago. Mr. Manley said he sees huge opportunities with Solus. He calls it a very unique company that is built on very disruptive, innovative products right at the right time in the marketplace, where big data, the Internet of Things, are just increasing the demands on enterprise infrastructure. So Mr. Betts said that the company was growing nicely even without this deal. They didn't really have to do it, but they were looking at ways to grow, and particularly looking at opportunities with their software version of their router. And this new investment from Bridge Growth will accelerate their growth. It'll give some liquidity to investors as well, but Mr. Betts said it will now allow Solus to chase all the opportunities associated with its new software version of its router.
And what's the new funding initiative?
Well, Ottawa-based search engine for the 3D printing industry called 3dprintler.com recently secured almost $1 million from a European angel, and now they're basically sharing some of that wealth. They write openly on their blog about how hard it is to get funding, and they're especially critical of the federal government, so they want to help people who may have the next big idea as much as they can, particularly in the 3D printing, 3D scanning, virtual reality, augmented reality, robotics, artificial intelligence, and bots sectors. So the idea, of course, is that people who have these ideas in these sectors will eventually join the 3dprintler.com ecosystem and use their search engine, which, of course, is good for them because they generate revenue by taking a cut out of transactions that happen on their platform. So they're looking for ideas, and they're offering anywhere from $5,000 to $25,000 per idea that makes a grade. They have about $100,000 available in this fund.
And who is speaking at the lecture on building a cybersecurity hub?
That would be Ronnie Zahavi. He is an Israeli entrepreneur and CEO of CyberSpark. Now, that's a well-established cybersecurity innovation center in the Israeli desert city of Beersheba. He was in town on Monday speaking at a lecture at Carleton, presented by the Israeli Embassy, Carleton's Technology Innovation Management Program, and Venus Cybersecurity Corporation, which is based out in Orleans. Mr. Zahavi spoke of the importance of synchronizing industry, academic, and government officials to create a vibrant ecosystem. Israeli Ambassador Rafael Barak said Canada and Israel are natural partners in this field. He says he foresees a future where the cybersecurity hubs in Ottawa and Beersheba can be closely intertwined in a larger global network of ties. And people came to this thing from as far away as New York, about 90 in all in attendance. And afterwards, everyone there started working together to identify various ways to bridge the Beersheba and Ottawa cybersecurity ecosystems. Some of the ideas included organizing a global competition for ventures in cybersecurity, developing interfaces into smart cities, enabling companies to match-make quickly and validate and test their proofs of concept in other countries, as well as organizing events like this one that enhance trust among participants.
And what's on the OBJ radar for this week, Tom?
Well, it's Franchise Awareness Day is coming up this week, John, and that will actually come with a special honor for one Ottawa-based company.
Well, thank you for a great update, and we'll talk again same time next week. Take care.
Sounds good, John. You too.
Now to Kevin O'Leary with our affiliate, BNN.
Talk baseball?
Yeah, I love baseball.
I saw that you actually have thrown out the first pitch at a Dodgers game before.
I did in Los Angeles, and I'm happy to say I got it over the mound. You know what the catcher told me the secret is? Because he's seen presidents do it for years.
Yeah.
Don't stay on the mound. Walk off the mound, walk about 2 yards in, be on flat ground, aim for the plate.
There you go.
Because what you realize is when you get up on that mound, it's foreboding. It's a long way to town. It's scary.
I don't know who you're picking to win in this home opener series for the Jays because you spent plenty of time in Boston.
Yeah.
But in terms of winning in the business of baseball, you have the euphoria around the Blue Jays at the end of last year.
Yeah.
You have a franchise that is now, I think, valued by Forbes or Fortune at around $900 million.
I think it's worth more than that, actually.
You think it's worth more?
I think it is worth more. I think if the Jays really went to market today, they'd fetch over $1 billion. I think they could be between 1.2 and 1.5 billion.
Wow.
You know,
they were saying they were...
Don't forget, Toronto's the fourth largest city in North America, and last year they really, really provided entertainment for people in Toronto.
Where do you weigh on this issue of sports rights? You know, we were talking about the Dodgers.
Yeah.
They pay a huge price for the team. They go create their own cable channel, and then they find out that people actually don't mind if they can't access the game, and so there's less leverage for the Time Warner cable created channel to actually get other pay TV players to pay up for the rights to the games. So does it really depend on having a really competitive team on the field to get people to pay, or are we just overpaying for sports rights these days?
No, it really does matter that you get a team that wins once in a while, because that's what draws fans into the emotional connection with the team. That's what gets them buying the hot dogs, buying the shirts, just being part of the whole franchise, being connected to their players. There's one exception in professional sports that actually that is against that rule, which is remarkable. It's the Toronto Maple Leafs. We all know they'll never win. And I've often argued that it's a form of entertainment. You know they're going to lose, you just don't know how badly. So I like to go and see how they lose. It's amazing. They can be up 4 goals and they still lose. I've always thought they should be the only team in the league to play without a goalie, so we can have these scores like 500-1, which would be very entertaining. They're losers, they always will be, but they're worth a fortune.
So O'Leary might pay $1.5 billion for the Jays, and if he owned the Leafs, there'd be no goalie.
I put, you know, the way I'd call them the cash flows, I pay them to win. I pay them a lot of money, maybe incentivize them a new way.
There you go. Thank you, Kevin. Happy Friday. Kevin O'Leary of O'Leary Financial Group. Armed with today's surprisingly strong jobs numbers and housing starts for March, the Bank of Canada will make its latest interest rate decision next Wednesday. What will the central bank's read on the economy be?
Okay, folks, stay with us. After the break, Matt Hendricks of Sprott Asset Management, followed by my interview with Eric Nuttall, who is the portfolio manager of the Sprott Energy Fund. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, as always, it's great to be joined by Matt Hendricks, who is Senior Vice President of National Sales at Sprott Asset Management. How are you, Matt?
I'm very well, John. How are you doing?
Okay. These markets are very challenging, and this week I have interviewed Eric Nuttall, who manages the Sprott Energy Fund, and next week I plan to interview Paul Wong, who runs the Sprott Gold and Precious Minerals Fund. And the reason I want to do that is because these are sleeves that are needed for a truly diversified portfolio. This week, by the way, I quoted on Bloomberg that the most expensive hamburger is now $25 in New York without fries, but there's no inflation. And Deutsche Bank, which has been under siege, and Deutsche Bank, as we've discussed, probably has about $60 trillion of derivatives strapped on, has sunk to a new low price level of about $15 US a share, and that's down from $120 going back 6-7 years ago. And it's one of the biggest banks in the world. But I'd like to ask you about the performance of the two funds mentioned, that is the Sprott Energy Fund and then the Sprott Gold and Precious Minerals Fund.
Right, John. Yeah, this week in the markets, I think we're going to end up slightly down for the week. And yeah, I mean, the performance of Deutsche Bank is just another data point that, there's a lot of trouble out there in the world. And, of course, we always maintain a Sprott. And on the show, you need to have a very diversified portfolio. And inside of that portfolio, I certainly recommend that you have a couple of sleeves, what we call some alpha-generating strategies, including gold and precious metals and energy. And Eric Nuttall has been simply knocking it out of the park on the energy side. His fund did over 26% last month alone and sitting healthily at the top of the Canadian energy funds year to date. And Paul Wong on the gold and precious minerals fund is up almost 40% year to date. So I really hope that the listeners enjoy what Eric Nuttall has to say in the energy space, because he is a very, very smart guy, and he's very sought after in terms of his thoughts on the price of oil, for one, and, of course, the stock, the underlying shares.
Well, I'm going to try and have the interview for next week's show with Paul Wong, who is manager of the Gold and Precious Minerals Fund, and we'll go to the Eric Nuttall interview now, but before we do that, could you give us your coordinates for listeners and advisors who would like information on the Sprott strategies?
Of course, John. I'm always reachable toll-free at 1-866-299-9906, and always feel free to visit Sprott.com. It's a great website full of wonderful information and data points on all of our strategies.
Well, thanks, Matt. Well, we'll talk same time next week. Take care.
You bet, John.
I am pleased to be joined this week on Money Talk by Eric Nuttall, who is the manager of the Sprott Energy Fund. Welcome to the show, Eric.
Hi, John. Good to be with you.
Well, thank you for joining us today. For our listeners, could you give us a snapshot of your background?
Yeah, sure. I grew up in Ottawa, born and raised, went to Carleton University, moved to Toronto about 14 years ago, roughly. Started at Sprott about 13 and a half years ago, working directly with Eric and Jean-François Tardif, looking at oil and gas names. And then I've been here ever since. So I took over the Energy Fund about 6 years ago, and also took over the Sprott Small Cap Fund about 2.5 years ago.
The oil and gas business has been a tough place to make money during the last few years, but I note that your fund is up about 18% year to date. I guess where I'd like to start is for your macro perspective of the oil and maybe then the natural gas business.
Sure. So our call is that oil will head to $50 by the end of this year, and we'll see around $60 in 2016. And it's really for two reasons. One, weak pricing is incentivizing strong demand. So last year was the strongest rate of growth. In around 5 years, demand grew by 1.8 million barrels per day. We're looking at that to soften a little this year, but still a very strong growth of about 1.2 million barrels. But most importantly is supply. At current oil prices, anything remotely close to today's oil price, there are no projects on the planet that make any economic sense to drill, which is why you're seeing a deferral in drilling, not just in North America, but around the globe. The level of spending decreases last year and this year are the largest in history. The number of rigs drilling for oil in the United States is now down 78% from the highs, and that's resulting in production falling and falling very quickly. So U.S. production is now down 700,000 barrels per day from the high that was seen last April, and we expect that trend to continue for the foreseeable future until you get a uptick in drilling activity in the United States. And in order for that to happen, you need a price response. So we think that anything under $50 will not motivate E&P companies to come back and begin drilling. And that's really only in the very best of the best place. The United States needs approximately $60 to be able to grow oil production, given their financial constraints due to excessive financial leverage from rampant spending over the past couple of years.
Now, did the market just overshoot on the downside and allow you to pick up some really good value?
Well, the market's a fickle, emotional beast, as everybody I'm sure is aware. So early this year, I was looking rather silly because we had taken the approach of going all in, so to speak. We had decided that buying stocks that had fallen by 90% already presented very good upside relative to the downside that they were already reflecting. We looked at the oil price from many years of experience, had strong conviction that the price level was unsustainable. We just didn't know if the turning point would be Q1, Q2, or Q3, but we bought stocks that had the financial strength to make it through weak pricing, and as a result, some of the holdings went up very dramatically. And, it'd be very easy to hear that I'm up, let's say, at 21-ish% after today and say, well, okay, we missed the upside. But what I would tell listeners to do is just pretend that they owned any other of my competitors, because many of them, my largest competitor, in fact, is actually down year to date while I've done well. So if people feel like they've missed the rally, they're not alone. Like 9.9 out of 10 investors have completely missed the energy rally. But where I get excited is that while I was ahead of the curve in calling for the price recovery to slightly higher than today's price level, where I think my investors have an edge is the benefit of a distinction that I've made looking out to 2017, and that is consensus would say that once you get oil heading above $45 to $50, you'll see a immediate production response from the U.S. that will quash any price rally, and I think that is massively oversimplistic. I think the reaction of U.S. production will be much slower than people believe. We have a write-up on our website under the Sprout Energy Fund that goes into detail, but to boil it down in a nutshell, it stems from the financial constraints that banks are now placing on E&P companies. The companies are constrained to only spending their cash flow. You also have labor shortages in that there have been 100,000 layoffs or more now in just the service sector. So when industry comes back and wants to drill, manning up the rigs is going to be a significant challenge. And then lastly, given the volatility in the oil price, I think executives not only need a high oil price in order to resume drilling, but they also need visibility that that price is sustainable, and that takes time into itself. So I think oil is going to spike higher than people believe, and it's going to stay high longer than people believe, given those three reasons.
Now, what do the weightings look like in your portfolio between oil and natural gas and cash?
Yeah, so we have virtually no natural gas exposure. I've been, as some of the listeners will know, very bearish on natural gas for, it feels like an eternity, and I'm holding to that call. It's been one of the easier ones to make. The continent is awash in gas, and compounding the problem has been this past winter, where effectively we had no winter. So if you don't have cold weather, you don't use natural gas to heat homes. It was the warmest winter on record, and as a result, storage levels, both in the United States and even more so in Alberta, are extraordinarily high. Compounding that problem is a lot of the growth in natural gas production out west is dictated not by the gas price but by the oil price, because along with the gas production they have liquids production. So as companies have continued to drill gas wells in a very weak gas price due to the strength in liquids pricing, has resulted in way too much production of natural gas. And at the same time, due to the complete incompetence of our federal government, there have been no creation of new pipelines or expanding capacity to get the gas to our largest customer, or our only customer, and that's the United States. So there's a significant bottlenecking within Canada, and as a result, Canadian gas, I think, is going to be extremely weak for the foreseeable future.
In terms of cash in your portfolio right now, what would you have?
Yeah, I don't specifically talk to it just because it can be a little misleading. I'm quite active, so if I sell let's say a 5, 6, 7% weighting, it can skew my cash. So what I would say is that I think the risk reward for energy investors is very, very good. I still see, even though we've had a strong rally from the lows in January, and the lows were at such obscene levels, nobody thought that things would get to that level of pain. Looking forward, I see very good upside. I think we have now eliminated the three major concerns that people had coming into this year, and that was that U.S. production wasn't falling, that demand was supposedly weakening, and that Iranian barrels would be hitting the market. All of those have either come to pass or been nullified. So long as investors are comfortable using a manager such as myself to manage their exposure, they should be happy to buy at any time, because it's my job to decide when the risk-reward is extremely compelling and when it's not. And when it's not, I use cash tactically. So we own names that we see very good upside in, and should there be a slight pullback for whatever reason that I can't foresee, they can rely on me to use cash tactically to add to exposure when things look very compelling. And it's something that we've done a pretty good job at as we've massively outperformed our index year-to-date for 3 years and even 5 years since I've been managing the fund.
Eric, that's a great update, and we'll look forward to talking again soon. And congratulations on your very solid performance.
Yeah, thanks very much.
We'll go to the news now, and when we come back, we'll be joined by Trevor Parry, who is an expert in taxation. And then we'll conclude the show with my interview with Steve Higgins, Director, Storage and Refining Solutions at the Royal Canadian Mint. Stay with us. You are listening to 580 CFRA.
Now back to Money Talk on News Talk 580 CFRA.
The end of April is looming, and we must file our taxes. I'm pleased to welcome Trevor Parry to Money Talk to give us his thoughts on the new Trudeau government's budget and some big changes in taxation. Welcome, Trevor.
Hi, John. Nice to be here.
Well, thank you for joining us this afternoon. To start, could you give us a snapshot of your background and business expertise?
Sure. A non-practicing lawyer living on the outskirts of Toronto, actually in Ancaster, Ontario. Have a background in tax. A few years ago went out and did another degree in taxation. And for a number of years crisscrossed the country, 80 to 100 flights a year, setting up advanced retirement structures for a big actuarial company. So specializing in things called individual pension plans and retirement compensation arrangements and all this neat kind of stuff. But that gave me a greater insight into matters of taxation, both in terms of practice and policy.
What are your thoughts on the huge new deficits that are ahead of us?
I should state from the outset, not a supporter of the current federal government for ideological reasons and for what I consider common sense fiscal reasons. I'm daunted by the proposition of $100+ billion being amassed over 4 years, with not even a scant mention of how it's going to be paid back. I think it's a recipe for, a Greece-type situation. I think that, unfortunately, the federal government might be taking its marching orders from Queen's Park, and we know how any sense of fiscal responsibility has been jettisoned by that fine government. So I'm quite afraid to what the consequences of this reckless and profligate spending will become.
Now, could you summarize the tax rate changes?
Well, they've introduced a tax cut in basically the $40,000 to $90,000 bracket, the so-called middle-class tax cut of 1.5%. And sure, that's wonderful. I always welcome a tax cut. But what they've brought in on incomes in excess of $200,000 is a punitive 33% tax bracket, which means that now in the fine province of Ontario, if you are working hard enough or fortunate enough to be earning income north of $200,000, you're going to be paying 53.51%. And on the other side of the river, I think it's a little less. I think Quebec is most likely going to have, for the first time in many years, an overall lower tax rate than Ontario.
And what does that mean for planning?
Well, it means that, again, planning has to stay inside the four corners of safety and sanity and understand the client's tolerance for risk and their appetite for planning. But I think it certainly is an invitation to those of us in the tax planning world to really show our art. Because, quite frankly, when you go north of a 50% tax rate, there is certainly an ideological, there's certainly an emotional, and I would argue a moral questioning that goes on for those making that kind of money. Why do I go to work? Why do I expose capital to risk? Why am I doing what I'm doing? So the tax planners in Canada are going to be very busy as a community for at least the tenure of this government.
Trevor, now let's go to the implications for insurance.
Certainly. There were two substantial changes in the budget concerning life insurance. And life insurance is used, in the tax planning world for tax reduction in some cases, but often tax deferral and tax mitigation. There were two substantial changes. One that was quite welcome. There were means of magnifying what we call the capital dividend account, which is the credit that can occur inside of a corporation when a life insurance policy owned by that corporation triggers. And what some in the planning community were doing by having joint ownership, for instance, having a holding company own a policy and the operating company being the beneficiary thereof, you could magnify the capital dividend account by, I don't want to get overly technical, but by removing the adjusted cost base from one corporation. So the feds have stepped in and quite rightly ended that practice. One of the changes, a substantial change in the nature of insurance strategy, was with regards to the transfer of life insurance policies. For a number of years, there had been a very popular strategy where if you owned a policy personally and you transferred that policy to your corporation for a bona fide business reason, that policy, or a good portion of it, could be paid out tax-free based on what we call the fair market value of the policy. And a number of business owners and professionals who were incorporated realized on this strategy and were able to capture or bring a lot of tax-free money out of their company. That's the nutshell of it. They've ended that. They've come in and ended that policy, and they've also been retroactive in that those who have already done this strategy will see the amount of benefit that they got out of their corporation levied against the tax-free portion of the death benefit of a life insurance policy upon their death. So that could have some substantial results and consequences to planning. We thought that would come to an end, but not in such a draconian fashion. We thought that they might tinker with the act and appropriately change certain what we'll consider loopholes, but they moved with a sledgehammer in that regard.
What are your thoughts on the ending of certain corporate and partnership structures to modify the small business deduction?
Well, again, not surprised that they did this. And this is where you had, let's say, 5 lawyers practicing in a partnership, and what they would do is rather than be a partnership of corporeal beings, as in the lawyers themselves, although some would argue that lawyers are not corporeal beings, they would in fact have a partnership of corporations, and that allowed each corporation to have its small business deduction. So it would be able to pay the preferential 15.5% tax rate on profits less than $500,000. What they've done now is they've ended that so that those 5 lawyers would have to share the small business rate, which will have some effect. It's not terrible. Again, this is where planning had gotten, a little cute, and the feds have stepped in and ended that practice. So not anything that was horribly surprising. What is, however, more concerning on the small business front was that they decided to defer the planned reduction in the small business rate of taxation, clearly sending a signal that perhaps the low corporate tax rate policy of the previous government, and in fact the previous Liberal government, has come to an end.
And what do the changes to corporate class mutual funds mean for tax deferral?
Well, a corporate class mutual fund had been around for, I guess, the better part of 20 years. It was a mutual fund structured around a corporation so that you could, in essence, move from one fund to another without triggering a taxable event. They are going to be modifying that substantially, removing much of the ability to defer tax. And that was the key. Often the first rule in tax planning is if we can't get a tax reduction safely, then the key is to defer. And in many cases, individuals with investment companies or holding companies would use a corporate class mutual fund, or what the government's called a switch fund, to prevent ongoing taxation year over year over year. So it allowed you to accumulate wealth inside your corporation and then take it out on a tax favorable basis as capital gains or dividends when you wanted to. They're really hammering that. They're also going after linked notes, which a lot of retail buyers have been using. The banks sell retail linked GICs, and what you were able to do with those in many cases was change the character of the income. Now, this started in the previous government, so I'm not going to lay this at the feet of Mr. Morneau, but they certainly are in the details going after the ability to defer or the ability to realize dividends and capital gains as opposed to income, which does have a long-term higher tax bill for the investor.
And finally, let's look at the implication for families with the end of the family tax credit and income splitting, along with changes to the child tax credit and other tax credits.
This is where I see sort of a knee-jerk reaction that anything that was implemented by the Conservatives seems to be removed by the new Liberal government. They have said that the new child tax credit is far more equitable. I'm always worried when equity is put forth as the primary reason, but they've eliminated the 2 previous credits that the Tories had brought in, and brought in one that is income graded, so it's certainly equitable in their eyes, but probably not in the real world. And for a government that prides itself on discussing and helping the middle class, I really challenge the fact that they are taking dollars from middle-class families in many cases. The biggest problem that I have is the end to family income splitting, which allowed for about a $2,000 a year tax savings for truly middle-class families, because it was isolated to a certain tax bracket, and if we were over $90,000, you couldn't utilize that income. So, again, I really challenge at a foundational level that policy move, because it's going out and saying, okay, we are out of one side of our mouth telling people we're there for the middle class, and yet we are going to remove a small but noted bit of tax relief immediately. And again, most Canadians should realize that most of our principal trading parties allow for joint filing of income tax. So families or married couples or common law couples can file a single return. They can do it in the United States, they can do it in the EU, they can do it in the UK. Canada, however, doesn't want to do that and unfortunately penalizes taxpayers in many cases. So it's something that I fundamentally have a problem with their action.
Well, thank you for an excellent summary and update. But before we go, for listeners who would like to be in touch with you and get your advice, could you give us your coordinates?
Certainly. I often work through your existing financial advisor, so they can certainly search me out. But I can be reached, and the easiest way is by email, and I'm Trevor, so Trevor, at one word, trevorperry.com.
Now, Trevor, I look forward to talking to you soon about what wasn't in the budget and what could be looming. Thank you so much.
Thanks, John.
After the break, we'll conclude this afternoon's show with my talk with Steve Higgins, who is Director of Storage and Refining Solutions at the Royal Canadian Mint. Stay with us. You are listening to 580 CFRA.
You're listening to Money Talk on News Talk 580 CFRA.
Well, it's great to be joined this afternoon by Steve Higgins, who is Director, Storage and Refining Solutions at the Royal Canadian Mint. Welcome, Steve.
Thanks, John. Glad to be here.
Well, let's get started with a snapshot of the history of the Royal Canadian Mint and its global reputation and your role at the Mint.
Okay. The Mint got started in 1908. We have been located in our Sussex facility since then, refining and producing gold and silver products for well over 100 years now. And we produce coins for all the domestic coins in Canada, and we produce coins for countries around the world. We've worked for 80 different governments over the years. We've got a very well-established collector coin program. We do our best to stay ahead of the curve on all the innovation in the collector coin business. And we're, of course, major producers of bullion products. We have the number one selling 1-ounce gold coin in the world and the number 2 selling 1-ounce silver coin. So that's a bit of the pieces of work we do at the Mint. Of course, we're refiners of precious metals and refine gold and silver that comes from mines and scrap dealers and turn those into high purity, beautiful products that we ship internationally.
Now, in your storage business, is the physical gold actually stored at the Mint on Sussex Drive?
That's correct. We store our gold at the Sussex facility.
And you have another facility in Winnipeg, is that correct?
We do. That's where we produce most of our base coin supply. So that's where we make all the coins for Canada. And in any given year, we're working for, a dozen or so different countries.
Now, I think it's important that our listeners know that you market your bullion and coins through dealers around the world.
That's correct. The margins on bullion products, as you can imagine, are quite thin. People want to pay as close as possible to the gold price. So for bullion products, we sell those out through distributors that are sold internationally. We do, obviously, Canada's relatively small market in the overall global gold bullion business. So the way that we make all our sales is to be able to ship internationally. So U.S. is a large market for us, obviously, Europe, and a fair amount into Asia as well.
Well, it's no secret that I feel very strongly about having a component of gold, silver, bullion, or exchange-traded receipt that, in effect, is proxy for same in all portfolios. And I think I'd like to go now to the Royal Canadian Mint's exchange-traded receipts listed on the Toronto Stock Exchange, and if you could shed some light on those particular vehicles.
Sure. The gold exchange-traded receipt and silver exchange-traded receipt, pretty simple concept, really. It's gold or silver, which is stored at the Royal Canadian Mint and traded on the Toronto Stock Exchange. So it's actual direct ownership in metal. It's a pretty old concept. It's a concept of a warehouse receipt. What we brought that was new is the fact that it's stored at a mint, which is an agent of the Government of Canada, and it's traded on a stock exchange. So investors can feel confident that their metal is there because we have enough metal to back 100% of the receipts at all times in the facility, and it's directly owned by the investors. They can withdraw it on a monthly basis, subject to some minimums and to some fees to cover the kind of the fabrication costs. But it's there, tradable, so it's very easy to put precious metals into a portfolio.
And can people redeem their receipts for either maple leaf coins and or bullion in the form of kilo bars or even 400-ounce bars?
That's correct. One of the things that we have as a advantage as a mint is we can turn the gold into whatever the end investor wants. So investors can get either the 1-ounce coins, the kilobars, or the 400-ounce bars, and that's all newly fabricated metal. It's all 4/9 purity in the case of gold, and it's shipped to you directly from the Royal Canadian Mint. So those make the most attractive redemption features that are out there. Normally, you can't get a variety of products from an asset manager because they have to ship you whatever they have on the shelf. We can fabricate new product and ship it out. So those are some of the best redemption features you're going to find.
And what is the management fee on these exchange-traded receipts?
Yeah, the management fee, too, is quite low. The Mint, because it's a producer and store of precious metals, we've got all the facility and the vaulting in place. And those are some of the largest costs in this business, as you can imagine. So the gold product's 35 basis points per annum, so 0.35%, and silver's 0.45%. Costs a little bit more to store silver. It takes up a lot more room for the dollar value. And, of course, to audit it takes a little more time. Our auditor, by the way, is the Auditor General of Canada. So if you look around, those are some of the best fees that are out there in terms of gold exchange-traded products. And
could you give us the ticker symbol for the two vehicles, and then also, are they eligible for RRSPs?
Yeah, absolutely. They are eligible for all the registered type accounts in Canada, so your RRSPs, your TFSAs, and the like. And the ticker symbols for gold is MNT. In Canadian dollars, there's a US dollar, which is just a .U, so MNT.U, and silver is MNS and MNS.U.
So people can own them in either U.S. dollars or Canadian dollars.
That's right. You can hold it in either account. It's really the same unit. So you might be buying it in Canadian dollars and someone else might be selling it in U.S. dollars, but you can hold it in either currency account. If investors want more information on the program, you can obviously talk to your financial advisor or have a look at our website, which is reserves.mint.ca.
And I always consider gold and silver to be the oldest money, and we're in an era of competitive valuations. So that's my rationale for having a component. As you mentioned, people obviously should talk to their registered qualified investment advisor. I'd be remiss if I didn't ask you for a comment on the current state of the physical gold and silver markets, supply, demand, etc.
Okay. Yeah, the Mint, obviously, we're in a unique position because we refine and also produce and are in the exchange-traded business. So I can comment on it in, I guess, three different ways. In terms of the supply, so refining, we've probably topped out in terms of mines. Mines have cut back on exploration and development work. And as a result, they're going to start to see a reduction in the amount of gold that's available. So there's people that are kind of calling a top of the gold supply for a few years until some of these reserves replenish themselves. In the scrap market, there's a pretty good correlation between metal price and or a financial collapse and the amount of supply in that market. So in our current situation, we've seen a drying up of supply from that market. So on the supply side, kind of we're topping out with a bit of an expectation to go down in the future. An interesting one is the exchange-traded product business, because that has gone from being a net supplier of gold over the last few years to just at the beginning of this year starting to be on the demand side. We've actually seen, since the end of last year, a 22% increase in the amount of gold in those programs. So that's about 9 million ounces of demand. And that's on there's about 100 million ounce supply of gold per year from mines. So it's not insignificant amount of demand that has suddenly shifted from being a net supplier to the demand side. So that's an interesting one. And we're also seeing and have continued to see, despite any kind of metal price movements and gold's come down in US dollars, but less so in other currencies. But what we continue to see is demand in the bullion coin market. We've had another very good year in 2015. Numbers will be out published soon, but I can tell you it was a very good year for gold and another record year in terms of silver 1 ounce sales. So investors continue to buy up these products, and that continues to be strong demand there.
Well, Steve, to conclude, we are finally getting into spring and summer, and I have to ask you about the tour of the Royal Canadian Mint, which is fun and an enlightening family event.
Well, that's right. It's a great thing to take the kids on or to visitors. We have facilities in Ottawa and Winnipeg. I know in Ottawa, you get to see all the precious metals being produced. So we pump out millions and millions of dollars worth of precious metals coins a day, and you can be right there and see what is effectively the largest manufacturing facility for these 1 ounce gold and silver coins in the world, and witness some of the artistry that's happening with the numismatics in a facility that's producing right in downtown Ottawa. And in Winnipeg, you can go and visit the high-speed facility. And I'm not sure about all the prices, but in Ottawa, I think it's $15 to bring a family of 6, so it's pretty cheap too.
That's fabulous. Well, this has been a great update, and we'll look forward to catching up again soon. Take care. Thank you.
I really appreciate the time. Thank you.
Thank you for joining us this afternoon on Money Talk for an eclectic mix of interviews, which I hope you found enlightening. And I hope that the markets treat you well in the coming week. We'll be back 2 p.m. next Sunday and look forward to you joining us. I'm John Budden, wishing you all the best. You are listening to 580 CFRA.